Hello everyone. So let's start with the third objective. Yesterday we were working on special order and pricing decisions. Today we'll start with third objective, how to make dropping a product and product mix decision. All right, so we'll start with an example. And we'll try to figure out what are the guidelines that we follow to drop or retain a product mix and how to change it as well. Okay, so the two key guidelines I'll remind you. First, we need to focus only on relevant data, right? And the second, we're going to use our contribution margin approach to make a decision. So relevant data, if we are within that period, so this is income statement for the month ended January, for the period ended January 31st, 2014. So we'll consider it relevant decision. Now what we're going to consider here is a decrease in volume. So this is a little bit different. We've done an increase, now we're doing decrease. And this is our special order. So what do we have here? We have two products. We have just our Excel DVDs, and then we have some specialty DVDs. So in quantity, one is 100,000 DVDs and the other one is 350 DVDs. So what do we have on our income statement? It's our sales revenue, variable expenses, contribution margin, fixed expenses, and operating income. Okay. So we're going to use the same process that we've discussed last class to drop or retain the product and changing the product mix. So the same thought process. So let's see, what is the difference here between our regular Excel DVDs and the specialty DVDs? What are we going to look at to make a decision? Well, first, if you notice, your operating income for the regular DVDs is $390,000. And for specialty DVDs, it's a loss of $420. So this should tell us something, right? If we are going to stay with the specialty DVDs or not. So naturally, this is not the number that anyone would like in their operations, right? It's a loss. So management is going to consider dropping this product, right? You don't want to operate at the loss. All right, so how do we make those considerations? What are we looking at? How do we make that decision? So while we're talking about dropping the product because there is an operating income with a negative number, which is a loss to us, right? It's not the only thing that we're going to consider. Not just the product can be dropped. It's also a department that might be eliminated, and it can be also a territory that might be disregarded, right? So managers often decide whether they're going to drop product, department, or territory. Also, looking at what contribution margin it carries. Is it positive or negative? While finding that it's a positive, a good thing, negative is something that we should consider and drop one of those aspects. Okay. So negative means it's not as profitable as desired. So the questions our managers are going to answer is, does the product, department, and territory provide a positive contribution margin? The second question, will fixed costs continue to exist even if the company drops the product? This is very important because while we think that something is bringing a loss, it is necessary to understand that when we remove that product, territory, or department, the company will no longer be at the loss. Okay, so we need to understand that what are the circumstances for that product having an operating income as a loss. So, and here they're going to ask one more question. Are there any direct fixed costs that can be avoided if the company drops the product, department, or territory? Well, dropping the product, department, or territory affects sales of the company's other products. So what would be that case? It's the case when one of the product might be necessary for the other. Okay, so if we are selling one of the products that is a complement to another, so dropping one product might also decrease the sales of the other. All right? So if I'm selling at a, I don't know, juicer or something, okay, and there is the part that I'm also producing that sells really well, the container where the extracted juice is pouring or something. So once I discontinue that juicer, that container is no longer be selling as well because it's compatible with my juicer. Okay, something like that. All right, so will dropping the product, department, or territory affect sales of the company's other products? That's very important to take into account as well. And the last question, what could the company do with the freed manufacturing capacity? All right, so if for example, we're producing a product and that product is taking half of the building that we're renting, now without production of that product, the fixed cost is solely laying on that second product that's produced within that building, right? So we're increasing the fixed cost for that other one. Yeah?
How do you calculate opportunity cost?
We'll do that. Just a little bit, hopefully today. All right. So that brings us to the next discussion. How do we decide whether the product provides a positive contribution margin or not? Because when we're talking about dropping the product, there are different circumstances that might be causing the negative income, right? The loss. So if the product has negative contribution margin, we want to drop it, right? Now, there are some fixed costs that are considered unavoidable. Those fixed costs are going to continue to exist. We're still going to acquire them, even if we drop the product. So they're irrelevant to making our decision. However, if the product line has a positive contribution margin, then it's going to help us to cover at least some of that fixed cost that the company is acquiring. So that is also an important point to keep in mind. So those direct fixed costs that are avoidable, right? We just talked about unavoidable. Those that are avoidable, they are relevant. We have to take them into consideration when we're making a decision. So when the costs are decreasing at the rate that is greater than the decrease in revenue, then the product needs to be dropped. Another question that we need to answer is, would dropping the product line, department, or territory hurt other sales, right? We just a little touched up on that. So here, as well as the complementary products that we might be losing a second one, we also have to consider lost contribution margins from other products. All right, so the last question, will more profitable products be produced with freed capacity? So a little more detail here. So like I said, if there is another production line, right? If we're using machinery to produce a certain product, would it be more profitable than using it to produce the dropped product? right? So one thing, if we have a freed capacity that's not used, and then the second factor is when we're going to use it for something else. Is it going to be as profitable or more profitable, right, than if we have a dropped product? So what is the decision rule for dropping the product, departments, or territories? So the question, do we drop? If our answer that the lost revenues are greater than cost savings, then we're not going to drop. If the lost revenue is less than cost savings, then we're going to drop that product. So what we need to do is compare the lost revenues against the cost that can be saved, right? And that we're going to do considering what we need to do with the freed capacity. All right. So if we have a product mix, right? Sometimes we're just talking about the one product, one department in their territory, but sometimes we have a mix. So what do we do there? Companies do not have unlimited resources. So we have, in the product mix, we have to figure out which product we need to emphasize. And we have some constraints here. One of them is when there is something that restricts production or sale of product. Okay? Another example, manufacturers. When we have some limitations on labor or machine hours or materials that are available to our production. Merchandisers. How much of the amount space do we have to display the product? And the competition, stiff competition that might limit our demand. So a company is going to only be able to produce as much as it can sell. So we have to take into account these constraints when we're deciding what is the product mix and if we need to drop either of them, either of the products in it. All right. So let's say a company can't sell all the products that it's producing. So which ones are we going to emphasize? How do we figure that out? So we have to consider what our product mix consists of. So for that, companies facing constraints, consider the questions that I have here. The first one, what constraints stop the company from making or displaying all the units that the company sells?
Limited shelf space.
Mm-hmm. Yeah, right? Which products offer the highest contribution margin per unit of the constraint? Another one, with emphasizing one product over another, affect fixed costs. So all these questions are important to answer before we make a decision. So what is the decision rule? Which product do we emphasize? Emphasize the product with the highest contribution margin per unit of the constraint. So we have to, all of this talk about the constraint turned out to be quite important, right? So we have to learn how do we calculate the contribution margin per unit of the constraint before we figure out which product that we're going to emphasize. So let's try an exercise. So we have Dealer Fashions that operates 3 departments. They have men's, women's, and accessories. Departmental operating income data for the 3rd quarter is displayed. And we're going to assume the fixed expenses assigned to each department include only direct fixed cost of the department. So salary of the department's manager, cost of advertising directly related to the department. And if dealer fashions drop a department, it will not incur these fixed expenses. All right. So let's answer this question. Should dealer fashions drop any of the department? So do we need to do some calculations? Do we have maybe a change in revenue? Maybe change in expenses? Right? What do we have here? It says that assume the fixed expenses assigned to each department include only direct fixed cost of the department. What does it mean? Is it going to affect any other departments? No, it's not. Good. All right. So should dealer fashions drop any of the departments? So just think of it. If I drop one, what's going to change? So what you need to calculate here is a change in your sales revenue, change in your variable expenses, fixed expenses if such, and total expenses, and see where your operating income is. So if we drop men's department or women's department or accessories, there's going to be a certain operating income. It's going to either go up or go down.
Accessories is operating at a loss.
So, okay, so would you be dropping accessories, men's, or which one? So would you be dropping it or would you be keeping it?
I would drop accessories as big businesses. Obviously at a loss.
All right. Okay, so let's try to drop, yes.
The new one would be 38,000, right? New operating income. Don't you don't subtract the 18,000 instead?
Would it increase and what would happen? Yeah.
The operating income, if you drop accessories, will increase $18,000.
$18,000. How did you figure that out?
Take out sales revenue. I mean, take out accessories department total. You can subtract 100,000 out of the total of 263, which will leave you with 163. And then you also want to subtract total expenses from men's and women's combined, as leaves you to 135.
Uh-huh.
And total comes out with the operating income of 28,000.
So that's what you got here. You're right, it's 18,000. Okay? So what we got here is that we definitely need to drop the accessories because they were operating at a loss, right? So our relevant expenses are 118,000, right? You just told us how to get that. And that means that there is an increase of 18,000. Okay? Did you understand how we decided on accessories and how we calculate? All right, cool. So let's talk about our next objective. We want to learn how to make outsourcing and sell as is or process further decisions. So managers often make or buy decisions, and those decisions are called outsourcing decisions. Because what managers are trying to do is to make a decision where they're going to buy a component or service, or they're going to produce it in-house. So would only a price or would only a cost for, let's say, labor an hour for a service be the only thing that we will consider? if it's cheaper for us to outsource? No, because cheaper is not always what we are going to consider. There are so many other factors, right? So for many companies, that would be sharing the knowledge, right? Once you're going to outsource, you will share the knowledge with the contractor. That's not always a desirable thing. So what other considerations? How do the company's variable costs compare to the outsourcing costs? Are any fixed costs can be avoidable if the company outsources? Right? Why is it important to us to understand if fixed costs can be avoidable if we can outsource?
Because we're not using our machineries and stuff like that.
So we want to avoid those fixed costs, right? What could the company do with the freed manufacturing capacity? Do you remember questions kind of mirror the ones that we had in the decision-making process? So what could the company do with that freed manufacturing capacity?
Use another product.
Maybe, right? So that's a decision to make. We need to have somehow this freed manufacturing capacity either engaged in another product, or maybe we need to get rid of it. All right, so let's go back to that Greg Steen story. Okay? So he is not going to be able to avoid any of the fixed costs by outsourcing. Let's just keep that in mind. So if fixed costs stay the same, then it's irrelevant to us. You remember that? And if fixed costs change, that's relevant to us. All right? Same idea applies. So we need to understand what is the difference between the alternatives that Greg's students are facing. So what do we have here? Okay, so companies' fixed costs are irrelevant. So we're going to continue to have this $50,000 on our books, right? Either way, doesn't matter. What else do we have? The variable cost of the liners, right? If we are going to, what does it mean by liners? It means we're outsourcing, right? So this is our outsourcing. So if we are going to buy them, that's $92,500 of excess and variable cost, right? We have something in addition to our variable cost. And here it's just 75, right? Do you see? So we have a greater number here. Okay, what else? Can we avoid some fixed costs here? Which one?
We're buying liners.
It's at 40,000 here, right? So it's 10,000. All right. So would we just think about this? Would you go with buying liners or making liners here? If you have your total cost of liners at 125,000 here and at 132,500 when we're buying, you would prefer making them. All right. So here what we did, we were taking into account relevant data, and we were looking at the fixed costs that are changing because they're relevant to us, right? All right. Okay, so company can avoid 10,000 in fixed costs if outsourced, but total costs are more, right? So where are our total costs that we're acquiring more? It's right here, right? So like we said, because the difference is 7,500, we're going to decide not to outsource. Even though in a fixed cost, fixed overhead is less, but the total cost is what we're going to look at. All right? So let's look at another important terminology here. It's our opportunity cost. So definition of opportunity cost is it is a benefit given up by not choosing an alternative course of action. Okay? So let me give you an example here. So if the company decides not to outsource, it will lose some revenue from the freed capacity, right? But if the company decides to outsource, the freed capacity can be used to produce other products, right? And it may even increase the earnings. So let's look at this example. We have make liners decision and buy liners, two alternatives. So what do we see here? If we're making liners, our expected cost of 250,000 liners is 125,000. If we decide to buy liners, we have two options. We're going to make additional CDs or DVDs or not, right? Two decisions. So if we are, we're going to expect some profit, right? But we're still going to have the same cost of 132,500. So what is it going to bring us to? Our net cost is going to be different from making liners and buying liners, right? The making liners, we're going to stay at 125,000. And if we are buying liners, we have two numbers. Why do they differ? Where do we have this 18,000? Where are we losing the 18,000?
You're taking a loss on the making additional CDs. Yeah, it's already posted.
Why do you think it's okay? Opportunity cost, right? All right. So what are the factors that we need to consider? We have a number of other factors, such as qualitative factors and globalization. These are more of concepts and not as much as something that you can easily calculate. So qualitative factors is our control over quality. Are we still getting the same quality of the product once we're outsourcing or producing in-house? Another factor in globalization is when we use the internet to find information systems of suppliers and customers that are located all over the world. Right? That gives us some advantage. So companies can now focus on core competencies such as quality and delivery. Okay, so another decision rule, and this one is for outsourcing. So let's look at this diagram. What are we going to do here? Should we outsource or not? Making a decision, we have to see what is the incremental cost of making versus incremental cost of outsourcing. If your incremental cost of making greater than incremental cost of outsourcing, then we will outsource. If the incremental cost of making is less than incremental cost of outsourcing, then we won't.
Is this why government would give a company tax breaks?
Is this why what?
A government give a company tax breaks so they don't outsource their company.
What do you call outsourcing in this case?
Sending their company from here to, let's say, India, because they get.
But it's not all that. Outsourcing is not necessarily to another country.
To another state. They wouldn't get a.
Yeah, it can be the other firm right here next door, right? So the tax break is different. One thing is if you're
So a government could give an incentive where the cost of making it here would be better than the cost of making it outsourcing.
but it's different from, yes, I agree. In general, yes.
I mean, it's different if it's more internal.
Yes. It's one thing if you're outsourcing abroad. Another thing is next door. So if you're still keeping it here, it's a different tax break,
Even Christie,
from my experience.
even Christie spent a lot of money trying to give pharmaceutical companies incentives to stay in New Jersey because they wanted to keep the tax code made in New Jersey, and jobs as well made in New Jersey.
Mm-hmm. So I guess because of the nature of U.S., it also depends if it's within the state or across the state. But that's what I know, dealing like with Texas. It is outsourcing, but it's not as bad if it's abroad, being in New Jersey. Right? Okay. So let's go back to our sheets. Okay. So another decision that we need to make is whether we're going to sell a product at some point of the process of a production, or are we going to process it further? For that, to make such a decision, we need to answer a couple questions. Do you understand why would you, somewhere in the middle of production, sell some items, right? So you might need to finish it before you sell it. And in some cases, you're not going to have a finished good to sell. I mean, it will be a finished good for your product line, right? But in fact, it's not a complete good, okay? So sometimes that happens. And to decide if we're going to sell it as is or if we're going to finish the production, process further it, we'll answer the following questions. So how much revenue will the company receive if the company sells the product as is? And then what we're going to compare this to is the answer to the second question. How much revenue will the company receive if the company sells the product after processing it further? So does it make sense to finish that product to something more finished than selling it as is? Okay? So the another question that we want to answer is how much will it cost to process the product further? Not only how much revenue it could bring us, right, whether we're going to finish it or maybe sell it as is, but we also want to understand how much cost it is to process the product further. So what are the examples? I give you a couple examples here. Usually in companies that do that are in process some raw materials like milk, corn, livestock, and so on and so forth. So think of it this way. Kraft must decide whether it should sell pasteurized milk as is or maybe process it further into some other product, dairy products, like cheese, sour cream, and such and such. Now, one thing is to just sell milk. The other thing is to process it further and have some other products to sell. Okay? So let's look at an example. Okay, so let's talk about a gas company. Let's sell this, let's say this is, I don't know, Chevron or whatever that is. Okay, so here's what I'm going to tell you here. So Chevron is going to sell their product either as is, or they're going to make a decision to process further. And we're going to help them right now to do that. Okay, so what do we have on the bottom here? What table is it? We can sell our premium gasoline at $4 per gallon. And that would allow us to, how much? Okay, that's 50,000, I'm sorry, 50,000 gallons at 4,000 per gallon. So we're going to get $200,000 of revenue. If we sell it at $3.80 per gallon, that would be 190,000, right? 50,000 multiplied by 3.8, we got 190,000 of expected revenue. Now we also know that the additional cost is going to be 15 cents per gallon. So it's 50,000 multiplied by 15 cents, we get 7,500 of additional cost, right? So you see how we calculated the first question, the second question, and the third question. All right, so what do we get? If we sell as is, our net revenue is $190,000. If we process it further, it's $192,500. So what are we going to do? We have a difference of $2,500.
Let's say process it further.
Why?
Because the conversion cost is only $2,500.
Okay. All right. So when we are calculating why we never, so we have the cost 7,500, if you can see it's here, right? 200,000, and then we have 190,000 here. Why do we not count in also this $125,000 of this cost? It's relevant to both, right? So it's irrelevant to making our decision, just to note this. All right. So we'll process it further. Yeah? Okay. So what is our decision rule? Whether we're going to sell it as is or whether we're going to process it further.
In that example, though, you have to take an effect that it's a price and people are going to pay the difference.
You're right. Yeah, are people willing to pay that much? I agree with you, but it's not the point. I agree with you. You're right. That's a good point. As we discussed last class, right? Are people, is it even the price that people are willing to pay? You remember how we went? We did the market survey, and we looked at what is the price that market or people, right, are willing to pay. In this case, it's just not the purpose.
So if we have an example like this on the exam, it's going to be like, we're just thinking about it very general, broad, as if it was an equal amount of parties.
If you have to take that into consideration, it's going to tell you that. In this case, no, that's not the point. The point is to illustrate how do we calculate these questions,
Gotcha.
right?
Thanks.
Just a second. All right. So what is our decision rule here? Are we going to sell as is or are we going to process it further? Here we need to look at what is the extra cost, right? That third line, and compare it to one of the first two. So if extra revenue for processing further is greater than extra cost, then we're going to process further. And if extra revenue from processing further is less than extra cost, then we're just going to sell it as is. We will not process it further. Right? That's the decision we just made. Intuitively, but that's a decision rule here. Okay. So luckily, we have another exercise. So suppose a roasted olive restaurant is considering whether to bake bread for the restaurant in-house or buy the bread from the local bakery. So we have our chef to estimate the variable cost of making each loaf. That's going to include 52 cents for ingredients, 24 cents for variable overhead, and 70 cents direct labor for kneading and forming the loaf. Right? Loaves, many of them. Yes. So allocating fixed overhead depreciation of the kitchen equipment and building based on direct labor assigns 96 cents of fixed overhead per loaf. So none of the fixed costs are avoidable. It's a bit different than what we had before, right? So the local bakery would charge $1.75 per loaf, right? All of the information above was what it's going to cost you if you're making it in-house. Now, if you outsource that to the local baker, it's $1.75 per loaf. So you want to answer the question. Question 1 is first that we're going to do. What is the unit cost of making the bread in-house? And let's use absorption costing. It's going to hunt you. Absorption costing. But we did an exercise, so that should be clear. All right, so let's do number 1. What you're going to have here, I'm going to help you a little bit. If you remember that exercise that we did for homework, you were supposed to calculate direct material, direct labor, variable overhead, and then add to that some of the fixed overhead, and then get the full cost per unit with that. Yeah. Anyone else? Wait. Anyone else got the number? You got it right, but yeah? 242 is the correct answer. Can you try at least jot something on the paper so that you understand if you understand it or not? So how did we get 242? You got it right. It's correct, yes. So what you did, you took direct materials, right, direct labor, and you added all of that to variable overhead, and then you added fixed overhead per unit, and that's how you got your cost per unit, right? So it's 242. What are we going to do here? We're going to try to answer the second question. Should roasted olive bake the bread in-house or buy from the local bakery? What do you think? Yeah.
I think that they should bake it themselves because that fixed cost is per baking each loaf of bread. So if they're not baking that loaf of bread, they don't have that fixed cost anymore.
That's right. That's right. So they should bake it in-house because variable cost is $1.46 for each loaf, and it's less than outsourcing, which is $1.75. So third question, in addition to the financial analysis, what else should roasted olive consider when making this decision? What else do you think?
If you're making decision that I have to take about the value of bread and resource.
Mm-hmm.
If you go like to increase the value of bread, the price gonna be lower and lower and lower.
Well, we don't know that, right? It's not given to us, but that's a possibility. That's right. Yeah? Time, okay. All right.
Quality control.
That's right. The most important is the bread that you're baking in-house of the same quality that you're buying, right? Another thing, you said time, right? Are they going to deliver on time? are you going to be able to bake it on time, right? So those two are main points, the quality and the delivery time requirements. Okay? Quality includes the freshness, so quality and delivery time requirements. Okay? Okay, these are some interesting exercises. So maybe we need to pay attention to them. In making short-term special decisions, you should use the traditional income statement approach, focus on total cost, separate variable from fixed cost, or only focus on quantitative factors. Who is thinking it's an A? Raise your hand. B? C? D? Yay! Okay. Let's do the next one. When making outsourcing decisions, expected use of the freed capacity is irrelevant. The variable cost of producing the product in-house is relevant. Avoidable fixed costs are irrelevant. And the total manufacturing unit cost of making the product in-house is much more relevant than incremental cost. A, B, C, D. Okay, so B or D? So when making outsourcing decision, the variable cost of producing the product in-house is relevant, right? We just calculated that. Okay. In deciding which product, you really want to listen to this. In deciding which product lines to emphasize, kitchenware.com should focus on the product line that has the highest contribution margin per unit of the product, contribution margin per unit of the constraining factor, or profit per unit of product, or contribution margin ratio. A, B, C, D, B or C, right? B, C, B. Contribution margin per unit of the constraining factor. That was on the slide as well. All right. When companies are price setters, their products and services, A, are priced by managers using a target pricing emphasis. B, tend to have a lot of competitors. C, tend to be unique. O, tend to be commodities. And D, tend to be unique. A, B, C, D. Let's see. Yay, tend to be unique. Good job. Okay. In deciding whether to drop its electronics product line, kitchenware.com would consider how dropping the electronics product line would affect sales of its other products such as CDs, the cost it could save by dropping the product line, the revenues it would lose from dropping the product line, or all of the above. A, B, C, none, D. Good job. Okay, couple more. Really want to do this with you, so wait. When deciding whether to sell as is or process a product further, managers should ignore which of the following, which information is the least important. The cost of processing the product thus far, the cost of processing further, the revenue if the product is sold as is, the revenue of the product is processed if processed further. A, B, C, D. So it's the cost of processing the product thus far that's irrelevant to us, right? Okay, which of the following is relevant to kitchenware decisions to accept a special order at a lower price, sale price from a large customer in China? The cost of shipping the order to the customer, the cost of kitchenware.com's warehouse in the United States, founder Eric Crowley's salary, or kitchenware.com's investment in its website? A, B, C, D. Which of the following is relevant to make a decision to accept a special order? A, B, C, D. The cost of shipping the order. Good job. Okay, 2 more and we're done. Which of the following costs are irrelevant to business decisions? Costs that differ between alternatives, variable cost, avoidable, or sunk cost. A, B, C, D. Yahoo, yay. Okay, next one, the last one. When making decisions, managers should consider revenues that differ between alternatives, costs that do not differ between alternatives, only variable cost or sunk costs in their decisions. A, B, C, D. A, D. Let's see. Revenues that differ between alternatives. Okay, lucky you, 21. Okay. Good job. Okay, so next chapter is our capital investment decisions and the time value of money. Okay. Building. Just a second. So we have the following objectives that we need to go over. We're going to describe the importance of capital investments and the capital budgeting process. We'll use the payback period and rate of return methods to make capital investment decisions. We'll also use the time value of money to compute the present and future values of single lump sums and annuities. Okay, if you don't remember that, we'll recover what annuities are and lump sums. And then use discounted cash flow models to make capital investment decisions. So let's start with the first one. We'll learn how do we describe the importance of capital investment and the capital budgeting process. So for that, first we want to understand what is capital budgeting. Capital budgeting is usually referred to the process of making capital investment decision. Okay, so the majority of your capital investment decisions are going to be referred to as capital budgeting. So it's a planning to invest in long-term assets, in other words, right? In the way that it's going to be most profitable to our business. So capitals make those decisions, long-term decisions, when they acquire some capital assets. And it's usually assets that are going to be used for a long time. Okay, so making capital investments is acquiring capital assets. And it is affecting our operations for many years. Usually such investments require a large amount of money. So what are examples? Capital investment, usually buying new equipment or building new plants, right? Some production automation, if it's something grand, right? And developing major commercial websites is another example. So in addition to altering in some way our operations for many years, right? capital investment is also a hit in the sense of how much money it requires, okay? So it's not your regular purchase. It's usually a large sum. So another thing that I wanted to discuss with you on capital budgeting is how do managers decide whether that expansion in plant or equipment is a good decision, is a good investment decision. How do managers make that decision? So there are several methods. There are 4 methods that allow us to analyze potential capital investment. First one is the payback period. Then rate of return. And these two are quick and very easy, and they work very well for investments that have relatively short lifespan. Okay, so payback period and rate of return. Now, net present value and internal rate of return are factors in the time value of money. So your rate of return is usually also called, I'm just going to note this if you don't remember this, is also called accounting rate of return. Okay? And all of these 4 are not quite an exact science, so it's still a manager's decision, right? It's all of the knowledge together. So if we talk about that Smart Touch company or Greg's Tunes, whatever that is, if they decide to expand producing some DVDs or manufacturing some new CDs, would they, what do you think would be the method that they would use? Well, interestingly, that it's usually a combination. Okay, it's never one. They quite often use at least a couple of these. So capital budgeting is not an exact science, but we do have tools to make it as close to the science as possible. All right? Capital budgeting is also focusing on cash flows. And the reason why is really in your general accepted accounting principles, because it's focusing on accrual accounting. It's based on accrual accounting. So capital budgeting focuses on cash flows. Also, capital investments cash inflows will differ from its operating income, okay, as another derivative of it. So what are cash inflows and cash outflows? The projected net cash inflows includes future cash revenue that's generated from that investment. It's also going to be future savings in ongoing cash operations, operating costs, sorry. And then future residual value of assets. It's a bit more complex. This chapter is a bit more complex, but we'll go slow through this one. Another one, is second side, is the cash outflows. This one? Well, I'll take out all the exercises so that you still listen to me, but yes. Friday. All right? Okay, so quite often, right, just natural, think of it, cash budgeting is going to tell us that the cash outflow is going to be significant, right? So initial investment is quite large. We're also going to include our ongoing operation cost, maintenance and repairs. Okay, so how are we going to estimate those numbers? Again, we said it's not a science, right? We can't guarantee the numbers here. But we're going to get as close as possible. Okay, that's going to be our relying on data that we get from employees, from experience, from managers' projections, and so on. So what is the process? Let's look at the process. We have 5 steps here. The first step, we will identify potential investment. So for example, new technology that, I don't know, maybe your competitor is using and you just have to do it to stay competitive. Okay? Something like that. Then 2 and 3 are a little bit tied together. We'll first estimate the net cash inflow, and then we will analyze investment using one of the methods that I gave you. Okay? Usually it's more than one, at least 2. The next step would be capital rationing to choose options. And then what we're going to do last, we'll compare outcomes post audits, after all audits are done. What does it mean post audits? We just want to make sure that everything is as planned, right? That's all it means. So let's see if we understand this. So what would be the first step that we're going to take in capital budgeting? Are we going to gather the money for investment? Are we going to identify potential projects? Are we going to get the accountants involved in the process? Or all together at once? A, B, C, D. That's right. First, like we said, identify potential investments. Then estimate net cash inflows, analyze investment using one of the methods or more, and capital rationing to choose options, and then post audits to compare outcomes, right? So identify potential projects is number 1. Yeah, it's not 12, just one question. All right, so second objective. We'll use the playback and rate of return method to make capital investment decision. Let me just do payback right now. So what is a payback? Payback is really your length of time that's going to be required for you to recover the cost of the capital outlay, right? So it's used to screen capital investment choices. And it's a length of time, like I said, that takes to recover the cost of capital outlay. With this payback period, we're also going to be able to measure how quickly our managers are going to be able to recover their investment. So we'll use this formula to calculate the payback period. It's amount invested divided by expected annual net cash inflow. And what is it going to tell us? Naturally, that the shorter the period, the more attractive the asset, right? We don't want to drag it through one to another period, right? The shorter it is, the more attractive the asset that we want to acquire. So another thing that I want you to notice is that when annual net cash inflows are equal, it's one thing. There are some cases that when it's not. We'll look at that as well. But for right now, let's just consider that we have equal annual net cash inflows. What does it mean? It's the same every year, right? So like we see business-to-business portal, and here net cash inflows, right? Our annual is 60,000 per year. Each year the same. And the same is here. So for this formula, we have equal annual net cash inflows, this case only. So we return, so we can calculate the return in savings or cash flows that are equal from year to year, right? Equal from year to year right here. Quite often they're just given to you. So our payback period is amount invested divided by expected annual net cash inflow. So what would be the result? What are we looking for here? What is the payback period? It's the number of periods, right? Number of years that's going to take us to pay back that investment. It started complicated, but the calculations are not that bad here, okay? So when the investment has unequal cash flows, okay, we have unequal annual net cash inflows, then the total net cash inflows until the amount invested is recovered. So what does it mean here? Let's see. We have a bit different here. 180, 50, 50, 40, 40, 30,000, right? That's a useful life of that asset. So what does it mean here? Why do I have 230 and 280 highlighted here? What we want to do first here is to recover that cost, right? So within what? 3 years we have 230,000. Okay? So our payback is going to take a little more than 3 years, but at first, it didn't say how much it was, right? Initially, they invested 240. I forgot to tell you this. Initially, they invested 240,000. So at year 3, we have $230,000 dollars accumulated. Okay? So it's going to take us 3 years and just a little more. So here you go, 280,000. Out of that 280,000, our investment was 240. Okay? So how do we calculate the payback? It's 3 years, right? 3 whole years. And now we need to understand how much is that portion of the 4th year that's going to take us to cover the investment. So 3 years, and then we'll take amount needed to complete recovery in year 4, which is $10,000. And then net cash inflow in the 4th year is 50. Okay? So what did we do here? All of the cash that was, so to say, flowing in, right? We were just putting aside for that investment, right? We were trying to equate it to the investment that we initially invested. So we had an inflow of 100, of 80, of 50. Okay, great, we're very close, but we're still missing at 10,000. So the 4th year, we're going to take 50,000, and we're going to take that number to calculate the payback. So 10,000 that are left off after 3 years that we've calculated, we're going to take 10,000 and divide by 50. So 10 divided by 50 is 0.2, so we have 3.2 years. Now, how we calculate, to criticize this method, we're going to do, let's just postpone it to the next class. Okay, right now we have